I'm going to call to order the meeting of the Retirement Board of Allegheny County. We'll stand if you're able for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Walt, could you please take roll call?
Absolutely. Ted Puzak, Corey O'Connor, Sarah Monrado, Frank DeCristofaro, Jennifer Liptak,
Here.
Sarah Roca,
Here.
Erica Broslers.
Present. And do we have any people online watching, listening?
The video is being broadcast
Okay.
online. I'm not sure if anybody called in. It sounded like it, but
Okay. Do we have any public comment?
we do not.
All right, we have items for board approval. Can I have a motion to approve the board meeting minutes from May 16th, 2024?
So moved. Second.
Hearing a motion in a second, is there any discussion? Hearing no discussion, all in favor? Aye.
Aye.
Any opposed? The motion passes. Next, we have a motion to accept, or I'm looking for a motion to accept the financial statements, which include the pension fund assets, the statement of changes in plan net assets, and the RBAC balance sheet as of April 2024. Can I have a motion?
So moved. Second.
Hearing a motion in a second, is there any discussion? Hearing none, all in favor say aye. Aye. Any opposed? Motion passes. Last, we're looking for a motion to approve the June 2024 invoices in the amount of $22,482.72 and to submit for payment.
Second.
Hearing a motion in a second, is there any discussion? Hearing none, all in favor say aye. Aye. Any opposed? All right, next we have applications for retirement, early retirement, and payment plans. Can I have a motion to approve the following June 2024 applications, which include 6 early retirement, 9 full retirement, and 1 payment plan?
Second.
Hearing a motion in a second, is there any discussion? Hearing none, all in favor say aye. Aye. Any opposed? It passes. Next, we have reports. Walt Zemansky.
Hi, thank you very much. So if you turn to your Managers tab in your board book, I'll highlight some areas on the dashboard. Retiree payroll surpassed 12 million for the first time last month, so payroll is up 8% on the year. Total contributions made are up 9.44%. Contributions refunded are up 9.29%. Total retirements on the year are up 18.33%. If you turn to the next page, pension estimates are up 2%. Capital calls are down 32.31%. And capital calls as of the prior board meeting were $431,480.17. The office budget is listed there as of May 31st, 2024. And are there any questions on the dashboard?
I don't have any questions.
Okay, so then just a couple of board updates to give the board. The new pension software calculator is currently being tested by a few departments. The rollout will add more departments over the summer as we get closer to the go-live date, and we're hoping to go live in August of this year. The ballots for the upcoming election were printed and mailed the first week of June, and the vote count will take place on Monday, July 1st at 9:30 a.m. in the elections office. Anybody's welcome to come up and watch the count.
And so those ballots need to be received
They need to be received by June 28th.
Okay, like 5 p.m., 4:30
Yep.
at the election department?
Yep.
Okay. Does the retirement office send out any email reminders or anything like that to?
We haven't in the past, but we can. We can maybe do an HR blast to just notify, please return your ballots by next Friday.
Okay, that'd be great. And I noticed when I received mine, like I knew it was coming. I'm wondering if next time around we can look at making printing something on the envelope to draw a little more attention to.
Sure, absolutely.
Because I think it's kind of nondescript mail, and if folks don't have it in their brain, then it might end up in the pile of nondescript mail.
And also, if anybody has lost their ballot, we have extras in the office. People are welcome to pick up, fill out, and drop off at elections too.
Great.
Okay.
Thank you.
You're welcome. And that's all I have this month.
Well, there we go. Any other questions for Walt? All right, next we have Brian Gabriel with the solicitor's report.
Thank you, Erica. The solicitor's report is current as of June 13. I have one action item that is on the agenda, and that is proposed resolution number 2024-1, which was circulated last month. This is an update relative to Internal Revenue Code compliance provisions. It's been some time, and so this is an update of those regulations.
Great, thank you. Do I have a motion to approve Resolution 2024-1 IRC compliance?
Second.
Hearing a motion in a second, is there any discussion? Hearing none, all in favor say aye.
Aye.
Aye. Any opposed? The motion passes. Anything else, Brian?
No, I'd be happy to answer any questions.
I don't think there are any today. Thanks.
Thank you.
For consultants, we have Mr. Brokaw and Mr. Walters from Mariner.
Thank you. If you turn to our tab, right after Walt's, you see we have 3 items to discuss. One is the market update through the end of May. The second is the updated investment policy statement, which is the same as your prior investment policy statement, but it includes, I guess it's about 3 or 4 pages that that we discussed at the last meeting regarding watch list criteria. And then finally, your portfolio review through April 30th. So if you turn to page 2 of the report, market update through May 31st. What you see on the left is good positive performance from the equity markets. S&P 500 up almost 5%, small cap, Russell 2000 up 5% as well, and international stocks, the MSCI EFA up 3.9%. And so you'll see when we get to April, and you may recall from the last meeting, April, negative performance, May, very positive performance that basically cancels out the negative April. And the market has continued to trend higher, various indices setting new record highs through the month of June. Fixed income, you see positive performance, the U.S. aggregate, broad market benchmark in May, the second set of indices here, up 1.7%. Interest rates declined over the quarter, as did spreads. Investment grade bonds up a bit higher, 1.9%. And that also, similar to what happened in the equity market, undoes what we see in May. So good month in May, June to date also positive. And again, the story remains the same. It's the market reacting to inflation reports that come out monthly, and that can swing things very positively or very negatively. So it looks like inflation, after a bad report in April, and May and June, relatively good reports, it seems like it may be trending downwards, which would mean potential for interest rate cuts, at least in the second half of the year, and probably more towards the end, if they occur. So that is the monthly update for the market. Any questions? All right, well, the next section, starting on page 3, Tim is going to lead us through the investment policy statement and the updated section for the watch list.
So, good afternoon, everyone. On pages 3 through 17, you'll find what is essentially a draft, revised, or amended version of the investment policy statement. On page 3, we do run through the history of when this IPS has been amended. And the amendments really start in section 7, page 12 of this section, where Chris and I inserted the performance scorecard and evaluation criteria that we discussed at the last meeting. The only changes that occurred, other than the insertion of this section, was a reformatting of numbers, sections, just to make sure that it flowed throughout the document. I don't know if the board wanted to specifically review any aspects of the IPS, but this is just to incorporate the section that had previously been reviewed, comments were offered or edits were afforded, and then this reflects that addition of the performance matrix and scorecard.
Do we need to formally approve this?
I believe we would like it to be voted on, and
Okay.
so it's in the record. And then
Okay.
this, if it is approved now, it would be implemented for the second quarter report,
Okay,
where then, starting in 2Q, we would apply these metrics to the manager's historical performance and present it to the board.
okay, and so 2Q would come out in like August? Okay. That's it. So I'll just, I read the section after calling Chris to confirm it was just the addition of that one section. I have a couple like tiny little like formatting comments that I can give to you all after. Based on what's in section 9 about the use of, because a question I had while I was reading it was, does it apply to our alternative investments or our illiquid investments? And then I noticed that the number 8, the use of commingled investment vehicles, which I'm assuming is the section that was around before, sort of speaks to that. Like not everything can apply to our specialty assets. So that answered a question that I had in my mind. One thing that I would like to get added is maybe it's just an appendix page to the investment policy that describes what the amendments are. So if somebody picks this up like a year from now and they're like, I don't know what they amended it for 2024, it would just say, you know, June 20, 2024 amendment, like added section 7, so that there's sort of a summary of what the changes were when we made them. Because I think at a point in the future, that's probably helpful.
Is there a time period you'd like us to go back? Because getting
I'm
some of
okay
the
with it
more
going
historical
forward.
ones prior to Mariner and Co. might be difficult.
I think if you want to put in whatever's easy, that,
And then we
I
can
was
work
thinking
with
here
Walt
going
to get
forward,
some other
but
ones.
yeah, because I just think starting, it will be good to have in the future, and we don't have to dig through the universe to find some old ones. Are there any other questions? I feel like I jumped the line. So it sounds like we're looking for a motion to approve the statement of investment policy as amended, as drafted by Mariner as of June 24th, 2024. Can I have a motion?
Motion.
Oh, yeah.
Are there going to be changes to it, or do you just have technical corrections?
Oh, sorry, mine are 2. It's like a G should be an A, and there's an extra space, so I don't have any.
There'll be a couple technical corrections?
Yes.
Okay.
Is there any other discussion? I'd be happy to entertain a motion.
I'll make that motion.
Hearing a motion in a second, any additional discussion? Hearing none, all in favor of this June 20th, 2024 amendment to the investment policy, say aye. Aye. Any opposed? Passes. Thanks.
Great. Thank you very much. And as Tim mentioned, we'll incorporate the new IPS into the reporting going forward. So yes, you are correct, Erica, that second quarter reporting will come out in August, and it'll have a few new pages that show how the various investments stand relative to these new metrics. So if you turn to page 20, you can see the portfolio through April 30th. And April, for the month, the first column there, you see negative overall performance, slightly better, your portfolio slightly better than the index. Stock market, U.S. market was down the most. You see U.S. equity down 4.4%, your portfolio performing in line with that negative benchmark. Again, May undoes a lot of that. Some items that are a bit different, and in this case positive relative to the index. If you look at the core fixed income, was down 2% versus the aggregate, which was down 2.5%. Some of the managers having a bit more exposure to some of the areas of the market that perform better, like corporate bonds, as I mentioned earlier, and also high yield bonds, and even some shorter duration, so shorter term bonds that are not as volatile when interest rates increase. So that was a relative benefit to the portfolio. The other one was high yield, where for the month, the high yield managers, relatively less volatile and less risky than the asset class in general, and tend to perform better in down markets, and they did this time as well. Other investments performing, again, roughly in line with the index. If you turn to page 29, I have a few comments on asset allocation, and that'll be the end of my prepared remarks, and I'll be happy to take any questions. On page 29, you see U.S. equity a bit over the target level. April 30th, that's before some of the changes in the emerging manager program with CIM and Fergaso. When those changes went into effect, those portfolios were liquidated. That'll bring the U.S. equity closer into line with the target allocation. Private equity, the third line down, you see 19.4%, a bit below the target, and private equity continues to make distributions, net distributions, even though there are some capital calls. Overall, there's net distributions lowering that exposure. Real estate, Washington, within real estate, Washington Alliance and Artemis are two managers that are calling capital, so that should increase the exposure to real estate in the portfolio towards the target. Infrastructure, just wanted to comment, they're making quarterly income distributions, so that should bring the portfolio back into line with the target, as well as generate cash for the ongoing cash needs in the portfolio. Those are my prepared remarks on the performance and the asset allocation. I'd be happy to answer any questions.
I think we're a question-free crowd today.
Okay.
If you bring us bottles of water next time, we'll have more
Next time.
questions.
Next time, hopefully, it's not 93 degrees.
It's only 93 degrees outside.
True.
Thank you.
Thank you.
I believe next we have Ed Boyer from Asset Strategy.
Thank you. Good afternoon to everyone. Thank you. So if you would turn kindly to the section of our report and notice on the first page, this particular page is dated December 31st. The subsequent pages will be for March. But the important thing to notice here is if you go down about 2/3 way down the column or the chart, you'll see Goldman Sachs. And we received a distribution from Goldman Sachs, the manager fund, which was the value then of December 31st was $23,000. We received a check for $17,000 and change. So that fund is clearly winding down, as is the other one. And what happens at this time of year, they often wait because there's incidental expenses that'll take place. They may wait until all the expenses come in for the year and wrap it up, the first part of next year. But whatever goes on there is immaterial. All right. If we could then kindly go to the next 2 pages, or 3, if you would. I'm sorry, maybe in the future we'll try and number these pages, but we were asked to bucket the assets classes together, as to whether it's venture or buyout or private debt, real estate, secondaries, and we used other as well. So if there's any particular data or questions you have about the way in which these are bucketed, or why, or would like any particular insight, we'd be happy to answer any questions. And you may need some more time to actually digest all this.
Could you give like the one sentence each description of the items that are under other?
Okay, great. So buyout essentially means that the general partnership is going to take ownership.
Oh, no, sorry, just the other section.
Oh, the other.
Like there's 4 investments in the
Okay.
last section.
So those 4 in the other, the CCA is Corey Capital, which is investing in life settlements. Okay. Would you like me to explain that any
Yep.
further? Okay. And Entrust does somewhat of a hodgepodge of a variety of investments. You can't say there's a concentration of a particular style. They have their managers they're used to working with, and some are debt, some are arbitrage, some are, buyout,
Okay,
but they're not easily put into the other categories.
thank you.
You're welcome. All right. So if we could go forward to the front page or the cover page that says the Retirement Board of Allegheny County calls distributions an estimate, June 2024. And so I think what your of particular interest would be on the second page at the bottom that talks about distributions at 16,200,000 and in the calls of 5 million. So the delta there is about 11 million of inflows expected, estimated. I might dial that back a little bit to 8 million just because we are estimating. But I think the one thing that this all hinges on is, how in real estate they call location, location, location? Well, here we're talking rates, rates, and rates. So it seems like the general consensus is rates are going to have a reason to drift lower. There's a lot of companies in the queue to be sold or have a transaction. And I think as long as rates seem to be drifting a little bit lower, we will see maybe this approach closer to $11 million. But I wouldn't bet my career on that at this point. But that's the trend. We owe you a pacing schedule, and we will deliver that at the next meeting.
I had a couple questions about this last section.
Sure.
So on the titles, there's uncalled capital as of last September. Then there's 2024 calls through year end. Is that just an estimate at this point?
So
Or is those actual calls?
we're talking uncalled capital?
No, so there's the uncalled capital column,
Right.
and then, which I assume it's just as of that date because it hasn't been updated?
Right.
Okay. And then the next, so it would be helpful if that were a more recent number, and the next time you present this report. Then the next one's called 2024 calls through Q4 2024. Is that an estimate?
Estimate, yes.
Okay. And then is that the same thing on the distributions? That's
Yes,
also an
it is.
estimate? Okay.
But bear in mind on the uncalled capital that all of this is not expected to be called. Okay? Managers are expected, we anticipate that they won't call all the money. In order to, they reserve some to have follow-on investments to support the companies they're invested in. And it's not uncommon for only 70 to 80% of the money to get called. So I don't think you're at as much exposure as the number might indicate of having to make commitments.
Yeah, and I understand that. I was just unclear on why a June 2024 report would have a number as of last September.
Okay.
Like that was more my
Okay,
my
well,
question on that one.
that'll be updated.
Okay.
All right. Any other questions that we can answer or address?
Thank you.
Okay, thank you.
Next, and always near and dear to my heart, are the actuaries. Thank you, Ed. We have, this is where I find out if I know how to say his name. Todd Kordecki from Acrisure.
Perfect.
Welcome.
Good afternoon, everyone. This is a bit of a new agenda item for us. It's something that we want to start doing. Brad and I have been talking about it, just kind of providing a quarterly update on the actuarial status of the retirement system. Some of these exhibits you'll see most of the time on the quarterly reports, but we're also going to try and keep it fresh and updated based on certain times of the year and what we think might be most relevant at the time. I want to quickly touch on just really 3 pages of this, the first being page 3, which is an update of the solvency projection of the retirement system. We had updated assets through March 31st, 2024. For preparing this analysis, based on the current contribution rate of 11% per party, with the county and the employees, insolvency is projected to occur in 2042. That's a 1-year improvement from the last time we looked at this for the contribution recommendations that we did in December, and those were based on September 30th, 2023 assets. Based on this analysis, the retirement system can avoid insolvency at a 14.5% contribution rate per party. So that's obviously a large number, and it'd be beneficial if we could find some different areas of funding for the plan. The next page is a chart that breaks down the contribution sufficiency based on a few different actuarial measurements that we use. The normal cost, which is shown in blue in the chart, is essentially the cost of new benefits that are expected to be earned during the next upcoming year. This chart shows each of these items as a percentage of employee payroll, so that we can compare it to the contribution percentage that's actually being made. The normal cost is approximately 9% of employee payroll. The plan's expenses are shown in green. It's just a tiny sliver between the blue and the gold bars. The expenses account for less than 1% of employee payroll. I think it's actually less than 0.5% of employee payroll. So normal costs and expenses combined make up about 9.5% of total payroll. The big drag that kind of prevents the plan's funded status from improving is the unfunded accrued liability. And the unfunded accrued liability is basically just the current funding shortfall of the retirement system, the liabilities that exceed the plan's assets. In order to improve the funded status, the contributions would need to exceed the first 2 items in the normal cost and the expenses, plus the expected interest on the unfunded accrued liability. And unfortunately, the expected interest on unfunded accrued liability is approximately 22% of employee payroll, which is what the entire contribution percentage is with the 2 combined parties. You can see the combined contribution rate is shown in the purple line that goes across.
So what you're basically saying is, what you're saying is we're not getting ahead because what we're putting in from employer doesn't even make up for what that 22%.
Right, so.
Right, and that doesn't include investments, right?
It does include the investments, because it's the difference between the liabilities and the investments. So the contributions are great to kind of cover the current benefits that are being earned. Like I mentioned, that's roughly 9.5% whenever you include expenses in there. So we're putting 22% in, but in order to kind of cover the expected interest on the unfunded amount, we would need to be around 32% or so, instead of 22%.
And I'm just going to,
And this is at 7.75%.
So the thing, a thing that, as I was talking about the plan last year, that struck me is folks' benefit is worth about 9 or 9.5% of their pay. And right now we have people paying 11% to earn that benefit. And I think that is problematic. And then to Todd's point, there's such a deficit in funding that it gets bigger every year. Then this is a room of sophisticated people, so this might be more for those watching at home, that just like if you don't pay the interest on your mortgage, your balance is going to go up. And that's very much the situation we're in. And until we find a way to put more money into the plan than is getting put now, this will continue to be.
Right.
To note, there was a period of time, though, where people were probably paying a lot less than what they were getting out of the fund for payroll. And so we're trying to correct for something that was done years ago. I think we started increasing the rate in, at least when I got on the board, 2008. Was that the first year we started trying to get that rate up above 6% because it had been at 6% forever. I got on the board and I think we bumped it to 7, which would be effective, I think, in 09, I can't remember the dates, but around that time. So it's been slowly trying to increase it, but for a period of time prior, I just wanted, for perspective, it was, employees were getting a lot more and not paying anything, and I think it went down to pretty much nothing for a period. You were here, Frank, it was ridiculous. So just for perspective sake, I think the board is trying, but I agree, we're not in the right spot right now. So I appreciate you putting that in perspective from what's going on right now.
Did you want to say anything else?
No, it was down 3%. At one point when I first started with the county, it was up to 14%. And then it went all the way down to 3%, and now it's up to 11.
Yeah, and the other thing I'd point out is, right, every time the board has approved a retiree payment increase, there's been no additional funding put in the plan. So if the last one was worth $20 million, that's $20 million that somehow has to get funded in the future.
Yeah, I think that's a very good point. We had a lot of discussion about that because, some of us felt like we wanted to give increases, but we didn't have the funding for it. So that's when a policy was put in place. And I think that policy expired, didn't it, Frank?
What, you mean the COLA policy?
Yeah, the COLA policy.
I think that's still in effect.
Is it still in effect? I don't
believe it is.
remember if it expired, if it was still in effect.
Policy.
It's if we got to a certain funding range and if we were over $1 billion, et cetera. I think we got that one time. So it's when we were solvent after we did the pension legislation. I think we did like a $25 a month or something like that COLA. But to your point, we have to have some type of structure because there's always pressure to give increases. And we all want to, but we have an overall responsibility for the entire fund, including the people who are paying in now. So probably we should look at that policy to make sure that we're up to date on that. Right? I thought it expired. I looked at that.
That was 2 years ago we had the last COLA increase.
Did that expire or was it?
I don't believe it expired.
Okay.
I think
I
it's
think it's still in
reviewed
place.
every 2 years, and it's based upon thresholds, like you had mentioned, with
Right.
hitting $1 billion in assets or
Right.
the funding level. So yeah,
It's also at the board discretion also.
Yes,
Something like that, yeah. And
if I remember correctly, I don't think it expires, but if the plan's over a certain funded percentage, there's a minimum COLA that
Right.
needs to be issued. If it's less than that, there's a discretionary COLA that can be issued up to a
Right.
certain amount.
Right.
thank you.
I think.
We should probably look
Yes,
at that, though,
that's
because it is,
correct.
it's hard. You have retirees saying, I haven't gotten an increase, but when you're looking at the overall plan,
Right.
it may not be in the best interest fiduciarily for the entire group we represent. So, okay, I'm sorry, I didn't mean to go off on a
Oh, I
tangent.
think it's great. You mentioned, Todd, that this is all at 7.75%. I don't know if you have a preview of what this sort of thing might look like at a potential future lower interest rate.
That's something we can incorporate
Okay.
into future exhibits, but the results will be worse.
There's what?
The results will be worse at 7%.
As I guessed. Sorry, I feel like we cut you off. Were you still going? through this
That
part?
was all I had for
Okay.
that exhibit, although I would like to say, Erica, that comparing it to a mortgage is a very good way to look at the unfunded accrued liability. You have that's basically your mortgage payment that you have to pay off every year. And as you mentioned, if you don't pay off just the interest on the mortgage, the principal that you owe will grow. So with a pension plan, you have the mortgage payment that ideally would be paid, plus you have the benefits that are earned during the upcoming year. So you have to pay your mortgage payment plus your normal costs and expenses each year to kind of eat away at that unfunded gap between the plan's assets and the liabilities.
So I have a couple more questions if it's question time. Is it question time or is it?
Do you want me to go through the last exhibit first?
Oh,
or is
sorry,
it
I thought you
based
said
on
you were
the-
done. No, please, continue.
I mean, were the questions specific to that?
No,
last
sorry,
exhibit? Okay.
I thought that's what I meant to ask, if you were done going through the exhibit, but you're not.
I have one
Okay.
more exhibit on the next
I'll
page.
save my questions till the end.
So this is just a chart of 3 different funded status measurements that we look at for the plan. The first one is the total funded status ratio. And this measurement considers the current assets and liabilities of the plan, but also includes the value of future contributions, future accruals, and future expenses. Kind of going back to our last exhibit, since the current contribution rate of 22% exceeds the normal cost and the expenses, the total funded status ratio is considerably higher than the funded status ratios on this page that only consider current assets and liabilities, because future contributions are the present value of future contributions exceed those future accruals and expenses that we consider for this measurement. The second measure is the accrued benefit funded status ratio, and that measurement values the liabilities based on actual benefits earned as of the applicable valuation date. So if an employee has 8 years of service, this measurement values their benefit with 8 years of service and their current pay history to come up with their liability as of that date and time. And the final measurement is the accrued liability funded status ratio, and that's based on the actuarial method that we currently use to value the plan's benefits. That is the entry age normal cost method, and this method projects employees' benefits over their entire careers and applies a uniform normal cost over each year of service. So this method recognizes normal cost a bit more quickly than the accrued benefit measure that is discussed in the gold data set, which is why this method has the lowest funded status ratio.
And just to make sure I'm clear on it, the top line, the total funded status, that assumes a sort of similar in the future workforce? Like
Correct.
there's sort of future employees
Right.
coming in and continuing to pay in, at both parties paying the 11%.
Exactly. So we,
why it's not.
for these projections, we assume a consistent headcount based off the January 1st, 2023 data, which I think is around 63 or 6,400 heads. And that is my last exhibit, so it's question time.
My question was actually back to the first page that you skipped,
Okay.
number 2, which was the trustees' goals. And I think this is a useful page in terms of us triggering discussion. I don't know if today is the day we want to have this kind of discussion, but I think we haven't yet as a board gotten to talk about like what our goals are for the plan. So I'll just give my reactions to a couple of these. One is, under short term, it said achieve a financial position from which projections remain solvent. And I think that's that's at least a multi-year, right?
It's a lofty short.
It's a lofty short-term goal. Like, it's definitely a goal. And then, reaching $1 billion in assets, I think is similarly, right? Like, we have to find the mechanism under which we can put more contributions in, as well as where that money would come from. And then I think we all agree that we don't want contributions to have to increase. So I appreciate this as sort of to get us thinking. I think as a board, it would make sense for us to get together at some point and have a conversation and come up with what our goals are, so that we can have that focus when we're having discussions. But if anybody else had any thoughts or reactions to it. Just me. All right. Anything else? Thank you, Todd.
You're very welcome.
What's next? Oops. All right. I've got a couple new businesses in this folder. So I think three items. One is we'll be having an executive session immediately following the public board meeting. Two, I wanted to mention now, I know historically the August board meeting has been, I don't know, canceled for summer break. If that's a thing we like that we think makes sense to do still, can we approve doing that now so that
Yeah, that's
do we
fine.
need like a motion or anything, or we
A
just?
motion
cancel?
just to approve the cancellation, then we'll post it and advertise that it's been canceled.
Okay. Can I have a motion to get, Corey wants it done. A motion, that's your birthday. The whole month of August. Corey was born every day of August.
Yes.
Is there a motion to cancel the August board
Motion
meeting?
to cancel the August meeting.
Second.
We've got a motion and a second. Any discussion? All in favor, say aye. Aye. Canceled, August board meeting.
We'll post that, and then just for procedure, you'll still receive an email just to approve August retirements and invoices, which then get ratified at the September meeting. So we'll just need an email vote on those, just the process.
Okay, great. And does each person reply to the group or reply to you, or how does?
Either way, reply all helps, or just reply to me. And once we get 4 votes, we process.
Okay,
So
great. Thank you.
thank you.
And then the last item is, today is the last board meeting on which Ted Puzak is officially a board member. He was unable to attend today, but we do want to thank him very much for his long service. He's been with the board for 24 years. We have and I've got it, I'll hold it up. We have a certificate of recognition. He was also recognized at County Council earlier this week, and I'm going to go ahead and read it. The certificate of recognition is awarded to Ted Puzak for over 24 years of dedicated service to the Retirement Board of Allegheny County. Ted Puzak has served as an elected member and vice president of the Allegheny County Retirement Board since 1999. During his tenure as vice president, the funded status exceeded $1 billion for the first time in the fund history. The retirees were granted and awarded 8 cost of living increases. A wide range of member education services were made available to plan participants, and new proprietary pension software was developed. Ted Puzak is a veteran of the United States Marine Corps, 1963 to 67, completing 1 tour in Vietnam with India Company 3 Battle 3rd Marines and Battalion. In 1973, utilizing the GI Bill, Ted received a BS from the University of Pittsburgh. He went on to earn a Master's of Education from Duquesne University in 1979. Ted retired from Allegheny County as a probation officer in March of 2001 after 29 years of dedicated service. Ted has always maintained a position of doing what's best for both the active and retired members of the plans. This has included lobbying Harrisburg on behalf of Allegheny County veterans in order to institute policies to make military service credit more cost-effective. In addition to his work in Allegheny County, Ted has served as an associate professor for 6 years at the University of Pittsburgh in the Health and Physical Activity Department. The Retirement Board of Allegheny County commends Mr. Puzak for his dedication and service to the trustees, retirees, employees, and citizens of Allegheny County. Thank you, Ted. And the next meeting is July 18th, and I'd entertain a motion to adjourn. All right, we're adjourned. Thank you.